Hello, welcome back to Core Finance. I'm Matt Brown. I'm joined today by Simon Watkins, who is a journalist and a financial author. And we're going to talk about all things OPEC. Big week this week, obviously, meeting on the 30th at the back end of the week. What's going on with OPEC? And more importantly, the Saudis.
Well, I mean, you know, the Saudis are a principal driver of OPEC and they have been since its establishment in 1960. OPEC's had a lot of problems recently, well, since the beginning of 2014, because the Saudis decided, not unreasonably, to try and price out the threat from the nascent US shale industry. And they decided to do it by overproducing and pushing down the oil price. That was sort of, as I say, sort of mid to end of October of 2014. So they did. Before they did that, the oil price had soared to about 147-ish per barrel of WTI. So they started to do this, and the oil price plummeted. At which point two things became remarkably clear. One is that the US shale industry was a lot more flexible than they'd thought, so that they could make, you know, their break-even was thought to be $60 to $90 a barrel shale, right? But actually, once this had begun, then it quickly transpired. They made lots of moves, the shale industry, technological and so forth, and financing structures, and they have started, as it stands now, they can make profits, if you're in the good regions like the Permian, at even $20 a barrel. So anyway, that was factor one that Saudis hadn't really thought through. So whilst the oil price was plummeting, the US shale was restructuring and making break-evens lower and positioning itself for good profits. So point two was, unfortunately, its neighbours, the big Middle Eastern producers, Kuwait and so forth, and Saudi itself, because of the nature of their oil industry and the nature of their budgets, were finding that they were losing hundreds of millions of dollars in budget revenues, and absolutely it was going through the floor, as we saw. I mean, in the first year and a half or so of this oil price lowering affected by the Saudis, the budgets of the immediate core Middle Eastern producers lost over $1.5 trillion in lost revenues between them. So that was stage one of this brilliant plan. Stage two was a complete reverse. It's a bit like in those Tom and Jerry cartoons where everybody's running in one direction and they suddenly go in precisely the opposite direction. So Saudis then decided to increase the oil price, so through cutting, and that's where we are now, that they decided to implement production cuts, sort of between, so the total would be, the idea was, the total worldly output from in total, but affected by OPEC and non-OPEC members, would be between 32 and 33 million barrels a day, which is sort of where we are theoretically. Theoretically, yes.
It's the key word, operative word there.
Yes, and so basically all the key OPEC members, which is basically OPEC membership accounts for about 40% of all world's output. They agreed to that. Well, we can come back to that. As you know, there's a problem with it, but they agreed in theory to cut each with their individual outputs, as did the Russians, which is the core non-OPEC player, normally produces anywhere between sort of 10 and 11 million barrels a day. It was about the same, actually slightly more than Saudi. And that is where we are. The problem is that, that because the markets know that, as you know, being in the markets yourself, markets people are paid to find out stuff, and because they know this is a lie, that people are cheating left, right and centre in many different ways, quite interesting, the oil price has not really sustained a good bull run. I mean, it was, before they started these cuts, which is December of last year, the oil price was struggling above 45 really per barrel of WTI, and yes, it's gone to nudge the high 50s, looking at the 60 resistance level. It may have gone through that since I came in, but that's where we are on WTI as well. Brent normally is higher slightly by $2 or $3, whatever. But the key question for Thursday is, as you know, in markets trading, there's a lot of buy the rumour, sell the fact. So at minimum, market players are looking for them to looking for OPEC and non-OPEC, very importantly, the two lots, particularly Russia, to extend these cuts. At minimum, that's the least that they can do. And even with that, because of the cheating and so forth, it is unlikely, I think, to lead to any firm tone in the oil price. I mean, the only thing that can do, and which has also conspired to support it, are the geopolitical security threats in, the Middle East, between Saudis, Iran in particular, and all round that crescent-shaped arc of increasing Shia power. I mean, Shia, that's S-H-I.
Yes. And that's the thing. I mean, it feels as if the OPEC meetings, there's going to be a bit of harmony there, but behind the scenes, if you look at the larger geopolitical situation, you look at Iran, Saudi Arabia, you look at Qatar, and again, you've got to look at what's going on with Russia as well. So it does feel as if the cuts or the continuation of the cuts will be priced in. The market expects that, but as you rightly say, it's the buy the rumour, sell the facts, and it does feel we've seen a small push up in the oil price,
yes.
But come OPEC, I think the market will probably.
I agree entirely with you, and I think the problem, the majority lift, I'd say, I mean, not to necessarily quantify it, but the majority lift in the price from say 50, let's say roughly where it was, to where we are now, has been on geopolitical security concerns. That's the big thing. The degree to which any OPEC cut, and the Russia cut, has elevated that is, I would say, minimal. So you've got to add into that. So let's strip out the security concern for a second in the price configuration. Let's put that to one side. So really, without that, you'd be still looking at about $50 a barrel, and that's top-ish. We can't really focus on the security concern, because we don't know what is necessarily going to happen. Yes. We can have a view, and that could spike the oil price, obviously, to whatever. But looking at the pure supply and demand elements, you have to come back to the way it was, the deal was structured, and the way it's being adhered and not to. And I mean, prior to December 2015, when the cut was introduced, you saw it's like when someone's mother says to the child, "You can't have any sweets." It's from 6. They pocket them all, don't they? And it was like that with the oil price and the oil cuts, because Saudi ramped up production like maniacs in the 2 to 3 months before they knew that they were going to implement it, to the highest levels ever, about 10.7 or whatever million barrels a day. Russia did the same. Everybody did the same. So in fact, the cuts, effectively, the empirical levels, are pretty much where they would have been anyway, if you see what I mean. So the markets didn't buy that, really. I mean, it was the portent of extra measures to come that lifted the price. It wasn't the actual cutting. And since then, we've seen, I mean, Saudi is regularly, I'm just trying to work out if this is litigious. No, it's not. So allegedly, Saudis are, shipping off another 350 to 400 or 450,000 barrels per day extra from a dark inventory. Sounds very conspiratorial, and is, but is held for that purpose. Russia's doing the same, these often to China, by the way, of course. And you've then got things like there are massive chasms in believability from the fact that, for example, there are exemptions to this cuts concept, which is that Iran, which is currently anyway one of the biggest oil producers in the world, it's a smidgen under 4 million barrels a day, but they have expressed and are putting in everything in place to get that ramped up to over 5 as soon as possible, with 6 as the target. So that's one exemption. They're not included, right? The Iraqis, for their part, they maintained, bizarrely, for some considerable time, that they thought the oil cuts were to do with exports, not production. I don't know where that came from. And Nigeria is not included because, there are geopolitical reasons and so forth. Same with Libya. Now, even before the cuts came in, Nigeria was moving towards sort of 1.5 million barrels a day in exports, in production, much of that exported, of course. Libya about 650,000 barrels a day, obviously security issues there. But now Libya is really well over 1 million barrels a day. Nigeria is about 2. And this just doesn't include all the sort of smaller ones like Ecuador would never take any notice anyway. So, and Iran, which is excluded, and Iraq, which doesn't seem to know what the difference between exports and production is. And that is where we are. So, in essence, really, the cuts from an empirical perspective are meaningless, particularly when you take into account the other big exemption, they were never going to be included anyway, is the US shale industry, which is the whole point of the whole thing in the first place, dating back for 2 years. Because the US shale industry, the idea was, a brief bit of stepping back, is that in 1945, I think it was September, the president at the time, US President Roosevelt, met with the king of Saudi Arabia at the time, Abdul Aziz, and they agreed a partnership. So the US could, the nature of the partnership was the US could rely on Saudi Arabia for all its oil and gas needs for as long as Saudi had hydrocarbons. And in exchange, the House of Saud would be defended by the US, which is what has largely happened for the last, since 1945.
Yes.
Now, the problem with that understanding came in 1973 with the oil crisis, when the Saudis encouraged its OPEC members and non-members to blockade, to embargo oil exports to the US and other foreign countries because of their support for the Israelis in the Yom Kippur War. And since that time, there was a shift in power. And ever since then, the US administration, been a policy of the US administration to try to break this deal,
yes,
to get off Saudi reliance. And the way to do it, the way this has come about in concrete terms, is through the rise of the shale industry, you know, the rocks and formations and fracking and so forth. And it has gone, it's powered ahead, really, over the last 2 years. I mean, rig counts have doubled last year,
yes,
to the highest ever. The EIA admitted, actually, I mean, that's a US authority, but also the IEA as well, which is the European equivalent, have said that US shale production is going to increase to well over 10 million barrels a day. Currently it's about 9-ish. That's next year. And there is really no diminution in terms of the demand side of things. I mean, yes, there are electric vehicles expected to come on the roads, but this is a long-term project, and China's energy needs, for example, are massive. So that you've got supply ratcheting up gradually with no end in sight, and you have a demand side that is robust, at least at current levels, and probably rising into the next 10 or so years.
So basically, with supply, I mean, it's basic economics. Too much supply, not enough demand, means the price should go down. Is it a bearish case now for?
Well, absolutely, and I think I think that you see, if you look at oil price cycles, you know, we had a commodities super cycle that we just came off the end of a couple of years ago, and oil was very much a part of that. And so that is one factor. That is over. That was powered by Chinese growth. But you still have high levels of Chinese growth. People always say, well, China's only growing at sort of 7 or 7.5%. Is it? Well, where else is, you know? I mean, that's very good. And it's more than enough to sustain our exponential increases in demand for oil. So you have that on the supply side, and you have people positioned for. I think I don't exactly know what people are positioned for being long. I think perhaps it's a bottom draw long for security concerns, you know, just hold it and see. But in terms of supply and demand dynamics, there's absolutely no reason really why it certainly shouldn't break through the $50 per barrel of WTI support level. And then we saw it go as low as, you know, with the overproduction side of things, below $30 a barrel.
Almost 25,
yeah.
Just finally, we've got to kind of wrap it up. Saudi Aramco.
Oh.
Where do you think they'll float? London or New York? Who will win this?
Well,
if they do.
Actually, I think there's a third thing that I've been covering actually quite recently, because basically, very quickly, the problem is that they're, quite aside from the fact that there are lots of problems with the Aramco thing itself, which is transparency, you know, the government will still own the concessions. That means shareholders don't. There's no, there's anti-monopoly rules, and Saudi Aramco effectively is the price setter. We don't know how much their reserves are. Their reserves are set at 266 billion barrels, but they've been like that for about 40 years, and they've been producing essentially 10 million barrels a day for that long without any diminution in reserves and no new reserves discovered. So that's a bit weird. In terms of the specifics, New York really has a problem, which is that there's reputational damage anybody that invests in Aramco, because there are 7, I think, lawsuits currently outstanding tying in the Saudis with the 9/11 attack. These are in US courts on the basis that 15 of the 19 Saudi of the attackers were Saudi nationals, and there are clear paths of funding that go from certain areas to certain areas. So that's a legal problem. The London problem is that the LSE recently, Xavier Rollet and Theresa May, hot-footed it to Aramco to try and win this. It's a good piece of business, if you like, that sort of thing. From the listing perspective, you know, the fees. But the problem is there that they had to, finagle the method of listing. It's basically you get all of the, Aramco is due to get, if it lists here, all of the upside of being a premium listing, you know, the publicity and the wider share ownership, you know, institutional shares and so forth, but with none of the tricky downside of having to tell anybody anything that it does, or indeed how much money or reserves or operationally, or anything at all.
So it's where's left? Will they look at
Hong
Kong, Japan?
My point, yes, my point. Thank you for reminding me. My point is that actually that's, I've heard from a few people that it's at this point, you've got to bear in mind that Crown Prince Mohammed bin Salman, the driving force of Saudi now, needs a face-saving device, because he has tied in the valuation of Aramco, which is 5% of the whole thing, and the whole meaning that he's wanting an overall valuation effectively of $2 trillion for Aramco, which means it's $100 billion for 5%. Now, as it stands, nobody thinks he's going to get that, with London or New York involved. But he has to domestically, because he's in a very tricky position. He'll lose face. So the segue that he's working on, I understand, is to do a private placement instead with the Chinese.
Yes.
That means you don't have, it's no discussion of price. There's nobody knows what he sold it for, and they still get some money.
Well, we look forward to that. You heard it here first. In the meantime, Simon Watkins, thanks very much for joining us here on Core Finance.
Thank you very much.